Hi, everybody. Welcome to the Patti Brennan Show. This show is for those of you who want to protect, grow, and use your assets to live your very best lives. Today, we are taking on a wonderful subject. It is the subject of the proposed tax legislation. And joining me today is none other than Eric Fuhrman. Eric, welcome to the show.
Thank you so much, Patti. And indeed, tax legislation, I think this is a topic mundane for most people, but our job today is to breathe excitement, electricity, and life to help people really understand how it can make a difference in their life.
Absolutely. And by the way, this is really interesting stuff. Just stay tuned because we have a rich history of how this whole thing called, income taxes really came about and why. It's a really, actually, when you dig into it, it gives, at least for me, it gives me a better perspective of what they're trying to do in Washington and why and how it really kind of gels out in the end, right?
Yeah, absolutely. So, there's so much to cover. I just hope we can condense it all into.
We will.
Yeah. So if you're driving, you might want to pull off into a parking lot somewhere because this is going to be good, right?
Yep, absolutely. Good stuff. And by the way, as always, all of this information will be on our website, keyfinancialinc.com. We've got a great white paper already done. It's got all the stuff that we're going to be talking about in today's show. So, Eric, let's start out with the history. I did a little bit of digging in preparation. I actually you did most of the digging, but I did a fair amount as well. But I wanted to kind of look back at the history and the intent of tax law, right? And when it first started.
Yeah, well, right, taxes have been around and been part of, any kind of great, great country and so forth. I think what defines our times, though, is that, so many people think in the moment. And since the 2020 election, there's been this steady drumbeat of major overhauls and tax law changes coming. And I just feel like so many issues that define the present, this is a very contentious topic. And really you have people split on both sides that they believe, taxation is a necessary tool to balance out income equality, to make needed investments. Others view it as kind of an overreach and expropriation of treasure from, people that, work hard. And it just kind of tears at that capitalistic identity that goes back to the founding of our country. So I don't know that we're going to solve, one side or the other. But I think, as you point out, the history is so interesting. That really kind of tells this story of, how it evolved, how we got here. And it just is able to allow you to understand the policy choices and why they're being made with just a much more informed or, enlightened perspective.
Absolutely. We are
right?
here
that's
to
what
enlighten.
we're all about. Enlightenment, right?
You got it. And have fun.
Yeah.
Have fun in the process.
Yeah.
So, when you look back, when did all this stuff started? Well, you know what? It started with the Stamp Act, right? It was, when we were colonies and Britain came out and imposed this Stamp Act. The colonists were not happy about it. They got mad, and guess what it led to?
Revolution? I don't know.
You got it. The revolution. Taxation without representation is tyranny. And that's really kind of interesting in terms of framing even today's conversation. So the Stamp Act was in 1765, led to the revolution.
Great year, by the way.
Oh, yeah. Wonderful year. Oh, yeah. And then we won that war, and then lo and behold, guess what came back? Okay, here we go. In 1797, there was a new tax that was imposed, and basically that was the beginning of what is now known as estate taxes. If someone passed away, you had to present the will with a particular stamp on it, and you had to pay for that stamp, and that was formed, and that new law was formed because we were kind of bracing for a potential war with France. Mm-hmm. Literally, that allowed us to build the Navy. That was the beginning of the United States Navy. We didn't end up going to war with France, but we had a Navy. Right. So most of the time when you look back at history, right, these taxes came and went, and it was typically to finance wars. Right?
Yeah, so what's interesting is when you think about a fledgling republic, like the United States was way back when, governments are scrambling to raise revenue. And, in a modern society, we take for granted that a government can borrow because we have a well-established bond market and a system to be able to raise funds from the public. But back then, really, your only way to pay bills was to tax or print.
Right.
And obviously, printing leads to very bad things, inflation and so forth. So this whole tax system that we see today has been evolving for hundreds of years. And I think it was Abraham Lincoln, back in, I think it was the Revenue Act of 1861, where he basically enacted the first, national income tax. And back then it was 3% on individuals earning above $800, which is about $18,000, adjusted for inflation. And that was kind of the genesis of kind of this modern day federal income tax. Now, the problem with a tax or authorizing one is you have to be able to collect it.
Well, I was just going to say, how in the world did they ever collect? I mean, there were no computers, there were no, how did they collect the money?
Yeah, that's a great question. Probably a subject for another podcast of collection methods. But the Revenue Act of 1862, passed a year later by Abraham Lincoln, was really meant to address that issue, and that really, provided the foundation for what we now know as the Internal Revenue Service.
So it's good old Abe, huh?
Yep. But there's been, throughout history, as you point out, there's been so many iterations of these different tax schemes and, bills to try and raise revenue. And this argument has gone back and forth right over the centuries. So this is nothing new today. But it really wasn't until the 16th Amendment was ratified in 1913, which really vested the power with the government to tax any source of income and kind of led to the modern day taxation system that we now see.
I think it's so, in preparation for this, I think it's so cool, that conversation you and I were having about, with the book that you're reading. Why don't you tell our listeners and people who are watching about the book and, the War of 1812?
Well, yeah, so the book is called Hamilton's Blessing, but it's just an interesting book because it really focuses on Alexander Hamilton and his contributions to kind of forming, the national debt and many different systems that we see today. But it really provides kind of a rich history of, how things changed, how it affected the national debt, how did the government raise revenue. And, it's fascinating for me, being a resident here outside Philadelphia, is that so much of that historical, those things took place right here in our backyard. So major figures, when you drive down Philadelphia and you see streets like Girard Avenue and so forth, like these are named after influential figures in the day that, were financiers and were part of this kind of amazing story of taxes and debt that take us to this point. So I'm not through it yet, but it's it's a page turner.
It's so interesting because back then, right before that war, the government was broke. It did not have the money to finance this war that we were about to go into. And so as I understand it, they went to this guy named, I don't know what his first name is, Mr. Girard.
Stephen Girard.
Girard, and said, hey, we need some money. And Stephen Girard said, okay, I got some money. And that's where he bought 95% of all of the government bonds. And he owned the bonds. The government had the cash. We went to war. And we won.
Yep. Yeah. So he was basically the richest man in America. He was a merchant out of Philadelphia. But yeah, the Treasury needed money to, continue the War of 1812. And they came to the one individual who bought 95% of the bond issue, which gave them the money to, to continue to do that. So,
what? I wonder what interest rate the government paid on those bonds back then.
That's I think there is mention of interest rates in the book. It escapes me now, but for us, we're kind of finance nerds and stuff like that. I mean, to be honest, I would enjoy a date night where you could sit down and someone would give you a 2-hour lecture on the history of taxation. I'd have to convince my wife, so hopefully there'd be wine service or something.
Oh,
there,
totally.
Who knows? Yeah.
Oh, absolutely.
Or otherwise, I'd be going solo.
All right. So here we have. Let's bring it to today. Here we have this proposal, right? Now, let's go through kind of a little bit of the mechanics of how do we get to where we are today? Who came up with these ideas? Who is responsible for kind of putting together this change in legislation, and what is that process all about?
Yeah, so I mean, I think what's important here, just to kind of close out the historical story, is really since the 16th Amendment of 1913 was ratified, right, we have this marginal tax system.
Yeah.
And so much about what the current law is about related to the individuals is really that top marginal tax rate or marginal tax bracket. And you can see that throughout history. The lowest bracket or the lowest rate has been very, very consistent. The top tax rate, though, has gone anywhere from 7% to 92%, which, that was right after World War II. So there's been tremendous volatility in that top tax rate. And it's a very kind of political issue because, right, wealthy households, high income earners are the people that are subject to that.
And it is an inflammatory issue, right? Because those same people say, we worked hard to get to this point, and you're killing us here. You're taking this money that we've earned and that's taken us a long time to get to the point where we can generate this cash flow. Let's talk about Hauser's law. I think this is fascinating and important for everybody listening to understand.
Yeah, so it was an interesting observation by an economist, many years ago. There's been criticisms to it, just like anything else, right? Everyone's going to have criticisms.
But the important thing is this is based on empirical data. It's not a theory.
Right.
We talk about Laffer's curve, and the idea of if you tax something less, you're going to get more of that thing, right?
Yeah.
This is not a theory. This is based on data.
Right. So it's not a kind of a theoretical argument that people can debate. But, what you see when you lay it out is that despite the top marginal rate being anywhere from 7 to 92%, despite the highs and the lows of that tax rate, the federal receipts, right, the money the government collects as a percentage of output being GDP, has stayed very, very consistent. Hauser's law observed about 19.5%. It's oscillated above and below that number, but about 19.5%. So, the inference is that regardless of how you manipulate the top tax rate, it really has not had any effect on increasing the government's share of output. And the lesson is if you want more tax revenue, figure out policies that increase output, because changing the tax rates really doesn't have any kind of material effect.
It is important, and it is interesting in terms of how they tinker with the rules, what you can and cannot do. Mm-hmm. Ultimately, the goal is to create revenue for the government to provide the services that so many people in America need. Mm-hmm. And that tight range of, 15 to 19.5% is really important. And let's face it, our economy has grown tremendously. We are a $22 trillion economy right now. Mm-hmm. So something's working, right?
Yeah, and I think that, the key here, not to get economical, or technical here. But the key is whatever these policies are, you just want to make sure that it doesn't discourage employment, that it doesn't discourage productivity of those that are employed. Really, the underlying thing that guides and drives standards of living is output, how productive we are. Can we be more productive with the hours that we're working? So you just want to make sure whatever the policies are, right, they're encouraging those types of things because more output leads to better standards of living for everybody. If the pie gets bigger, everybody benefits.
Right. I think, in our conversation, we were talking about taxation, policy being initially to provide economic value, and it has now become a little bit more social value, right? Mm-hmm. What is the intent that we're trying to achieve here?
Yes. Is there some kind of economic engineering that's behind the changes? Is it a social kind of engineering that they're trying to?
I like that better, the engineering, because that's really what's going on.
Yeah. Is the tax system used to raise revenue to pay for important things, or is it used to kind of create certain outcomes, socially and so forth?
Close the gap between the rich and the right.
Yeah,
exactly.
Which, again, this is not a new argument, right?
No,
this has been going on
absolutely.
forever.
And we're not going to solve it today, but it just kind of does make me think a lot in terms of what they're trying to do down in Washington.
Yeah, exactly right. So but, on to the new tax law, right? We digress.
And let's get, and we're going to, as always, we're going to get into actionable items throughout this podcast and at the End of the show. Key considerations, right?
I was gonna put a plug in for there. You beat me to it. I was
There you
gonna say,
go.
what do you call that?
Right. I
Key
think we call it
consideration,
key
right?
considerations.
Okay, good.
And again,
Mental
none of this
footnote.
is advice, right? We just want you to consider, go to your advisors, understand that these opportunities are here now, and they may may go away as of January 1st.
Yes,
That's
some of
the
these
most
things,
important
yeah,
thing.
could be ephemeral. All
Yep.
right, so
Good deal.
individual income taxes.
Yeah. Well,
do you
you know
say?
what? Let's get one thing out of the way.
Okay.
How about we get the international tax law out of the way? Lots of changes in this proposal as it relates to the international tax system. A
You
lot
must be-
more. Well,
yeah,
go ahead.
I was going to say you must be referring to the globally intangible low tax
Oh, yeah,
income, or maybe
okay.
the more obscure foreign derived intangible income
Right.
tax,
Talk
right?
about a snooze fest.
That
Oh,
is a snooze
man.
fest for
Okay,
us,
so
for sure.
we're not going to talk about all that. That
Okay.
is part of this legislation. It is something that they want to target.
Yeah, I think that the thrust is really targeting multinational corporations that have great ability and resources to defer, hide income, and so forth. Yeah.
You got it. Good. Okay, so let's focus on the income tax changes as well as the estate tax changes because they're big. I'm going to say especially the estate tax stuff. Yeah. So let's focus on the income tax. What's the proposal say? Who's it going to hit? And what should people do today?
Yeah, so I think you always have to think about in these first couple situations is the rate and upon what level of income does that rate then apply. So the first is really this proposal, keeping in message with the whole election cycle that we're not going to raise taxes on anybody above $400,000 or below $400,000 of income. So the next proposal says let's take that top tax rate of 37%. Go back to the 2017 level of 39.6, but rather than have that 39.6 kick in at $628,000, we want it kicking in at $450,000 if you're married, $400,000 if you're single. Now, statistically, right, if you're making $450,000 a year as a household, you're in the 98th percentile. So that, again, is it's not the proposal wouldn't apply to a lot of people, but that's one of the first changes that is being considered.
Yeah, so more of that income is taxed at that higher rate. So, and we're talking about almost $180,000 taxed at that top tier. So it is not inconsequential.
Yep.
So it's a broader tax. More people are going to be caught in that highest tax bracket.
Yeah, and then there's this other kind of interesting one that would be brand new, which is the surtax. If you're in an extraordinarily high income year, where if you're married, your adjusted gross income is over $5 million, $2.5 million if you're single. But this is something that would be brand new. And again, it would not ensnare most individuals, but it would certainly affect people that have a large transaction that occurs in a single year, like let's say a sale of a business or some kind of divestiture of a major asset.
Yeah, real estate, something of that nature. And it's setting a precedent also that's saying, okay, if you're at a particular tier, we're going to hit you with a surtax. And, again, we don't know what we don't know, but I wouldn't be surprised if now if this gets passed this way, the level upon which that surtax hits could affect more people going forward. I think the key thing that you said there, key again, Eric, is adjusted gross income, because that is different. Really important. Everybody listen up on that one.
Right. So all of these tax laws that are proposed are based on adjusted gross income. So a lot of people would think, well, how can I evade this? Maybe by making a charitable contribution or having,
Mortgage
additional
interest,
deductions.
right.
All these things are being applied, on basically adjusted gross income. So that's or at least the surtax in that case would be applied there. So it's a key consideration.
Yep.
Right?
Be careful. Be careful. Don't get caught in that.
Yeah.
So basically what we're talking about is instead of 37%, the exposure is 42.6 all in.
Right. When you add everything in with the surtax and so forth. But, this is kind of brings into play, if you're not maxing out, employer-sponsored retirement plans, if you're kind of a higher level employee that has access to a deferred compensation plan, these are vehicles where you can get that AGI number, down below the limit.
It is really important. Yeah. That is very, very key, because there's a domino effect with all of this. Not only are the ordinary tax rates affected, but so are capital gains, right?
Yeah, exactly right. And this really requires kind of advanced planning and modeling because things like a deferred comp plan, has to be made in advance.
Right.
You can't change it. You got to make it the year before. So you really have to really kind of look at the bracket and look at all your options.
Which is why we're talking about this right now. Always remember, by the way, those of you who are listening today and watching this video, this is based on what we know today, right? They're still making the sausage. These rules can change between now and when and if this thing eventually gets passed. So stay tuned. We'll be doing probably another podcast. But in the meantime, look at worst case scenario and understand that now is the time that most employers are requiring you to make an election on your deferred comp plan. You may not have been involved in it. This is the time to look at it really closely. Because worst comes to worst, you're reducing your taxable income. Even if the tax rates stay exactly the same, you're just taking additional money and putting it away for later on. Mm-hmm. It's a forced savings. It depending on your employer, and you have to understand the rules of your plan and understand potential risks. But boy, it's good sound planning anyway, right? So talk about capital gains.
Right. So let's think of this in the old-fashioned term, right? We're talking about a tax on labor. What about a tax on capital?
Right.
So now, that's a separate tax regime, separate tax system, and the rules are changing there as well.
Here's the thing that kind of made me mad. I don't know about you, Eric, and those of you who are watching. They kind of slid something in at the last minute, and here's what it is. This 25% rate on capital gains at certain, levels. Okay, that is retroactive to September 13th of this calendar year. So if you sell anything after September 13th and you're ensnared in this, and by the way, the new rates, they don't become effective until January 1st of next year. So we're talking about those people who are for joint filers who may have income over $501,000 plus or minus, right? So if you're in that bracket and you sold something after September 13th, you're paying the higher tax.
Yep, exactly right. And it is kind of sneaky, to slide it in because it's basically, I guess the idea is they don't want people rushing for the exit before year end.
Which is exactly what we would be doing, right? I mean, I don't know about you, but we'd be making some phone calls and doing the analysis. I mean, Eric, we already bought a software program to do the analysis to say, does it make sense to sell the for capital gains at the current rate or wait? Right? And at what point, what's the crossover period? So that's off the table. So much for that software.
Yeah. Yeah, right. Well, that's the way software goes, right?
Yep, you got it.
But no, again, it's that same old, the same old story here. It's the rate and what income does that new rate apply. I think the vast majority of people, the same rates of 0 or 15% will apply. It's only, again, the high income earners. So they're increasing the rate and lowering the threshold when that rate, when that rate kicks in. Now, the good part about capital gains is that, you do have a measure of control over when things are realized. So, ideally that might mean holding on to an investment and maybe selling it over time rather than it all at once, like let's say when you retire. But it's challenging because there's always risk to holding an investment.
Right.
As you always say all the time, I'm going to steal a saying from you, don't let the tax tail wag the dog.
Yeah, fundamentals are important because, yes, there might be a tax, but don't you want to keep the money? You're still going to keep 85% of whatever it is. If you're holding onto an asset, whether it be a stock or a mutual fund or a piece of real estate, especially right now, okay, you might have to pay a higher tax, but you're still going to end up with more money.
Yeah, and I mean, I think it's an important distinction here to remember too. What's the goal of investing?
Yes.
The goal is to, for appreciation, to make a profit. So wherever we can be strategic and help smooth that out or lower it, absolutely you want to do that. But I would much rather pay a capital gains tax than have a carry forward loss.
You betcha.
Right?
Absolutely. Yeah. And I think that for those people who are listening, there are certain asset classes where you can do it over time. That's called an installment sale. That's probably going to become very popular for those of you who own businesses. Rather than get a lump sum, have an installment sale so that you're not paying taxes all at once. That's still available. There are definitely still some planning opportunities for people who own businesses, both from an income tax and an estate tax perspective.
Yeah, and then I think there's this other sneaky one that hides, in the in the tax code, which is this net investment income tax.
Ugly.
So, in the current law, it's this 3.8% tax that gets applied above, certain income levels, but it's being applied to passive income. So things like, interest income, dividends, capital gains. Well, they're expanding the definition. So now it's not just passive income, it's income earned in any kind of, trade or business. Now they're going to raise the income thresholds before this kicks in. But again, they're expanding the definition. So again, really targeting high income earners, which tend to be business owners and things like that.
Yep.
So
Realtors, everybody. You got another 3.8 stacked on top of everything else.
Yep. So we're going to have that.
Okay. So let's talk about the estate tax changes and the gift tax changes, because that's big.
Yeah. I feel like for you, this is like the icing on the cake, right?
Well,
this is your forte.
Yeah.
Right?
You know what? I just think it's just, I don't know, maybe it's philosophical, but, people work all of their lives to save, accrue, pay the taxes, done, you set it aside, and then somebody passes away and you're getting taxed all over again. And under the current law, you can leave $11.7 million per individual to your heirs. It could be your children, it could be other people, etc. So a couple can leave $23 million without a federal estate tax. The excess over that is taxed at 40%. Keep in mind, everything you have is included in that number. So it is the value of your home, your retirement plans, your life insurance. Everything is included no matter where it's located. So it can add up pretty quickly. Now, the new proposal is basically accelerating the time when the sunset provision was to kick in. So the sunset provision, we kind of knew that they were probably going to take that 11.7 back down to 5.5. What they threw in here, again, this was a surprise. I don't think anybody was really expecting it, because as they were doing this, we had lots of people in Washington who were giving us updates in terms of what was and was not included. And estate reducing the amount that you can leave to others was not part of this initially. And then at the last minute, it was included. So basically, under the proposal, effective January 1st of next year, it is scheduled, or the proposal is $6 million per person. Still a lot of money. So, let's kind of, understand that most people are still not going to be affected by this, by estate taxes. But for those of you who are listening, where when you add it all up, it is currently, close to that point, because remember, chances are you're not going to die tomorrow, right? And really the estate taxes are due at the second death, right? So hopefully you're going to live for another 10, 20 years. So the question is, well, what happens in 10 years? What is your estate going to be in 10 years or in 20 years? So to understand the scope of the issue and say, well, is there anything that I want to do now to capture what we have until December 31st? And then going forward, what do we do from there, right? So how do we do that? What do you do? What are the options? So, and by the way, the rate is going to increase from 40% to 45%. So again, higher rate on the excess over that amount.
Yeah, I was going to say, it sounds like we're moving over to a key consideration.
Yes,
right?
Very key.
So is this where you're going to take a sunset and make it a sunrise?
Check it out. Oh, yes. Well, we are going to do a sunrise, absolutely.
Because we're all about the sunrise.
You got it. And you know what also? There's a great opportunity through the end of this year to do something and to capture something that we will probably never see again in our lifetimes. Mm-hmm. That's pretty much everybody's assessment.
So the idea is try and use it before you lose it.
Exactly.
Right? And,
so
what are the strategies you can do that? Right?
Here's the deal. Okay, so let's pretend, Let's pretend Ed and I have a taxable estate. So basically, you can do something called a spousal lifetime access trust. And I'm making him do it. Right? I'm making him do it.
What? So he's giving you the gift.
Oh, yeah. You better believe that.
Very generous.
Absolutely. So he's going to put in 11.7 into this thing called a Slat, or spousal lifetime access trust. Now, keep in mind, he's still alive, right? And I'm alive, right? So I have lifetime access. I can get all of the income. I can get whatever I might need for my health, education, maintenance, and support. Okay, those are called the ascertainable standards. It has been tried, tested, you're good. Okay, so, okay, he puts it there. We have access to it if we need it, when we need it. To the extent that we don't, here's where the real benefit comes. First of all, okay, we are getting another, $5.7 million that out of the taxable estate never was taxed, okay? That's just the beginning though, Eric, because in addition to that, to the extent that we don't use it, use the rule of 72, 7% rate of return, every 10 years, that capital will double. So, round it up. 12 million becomes 24 million, becomes $48 million. In just 20 years, by doing this thing called a Slat, we've avoided the tax on almost $50 million. At 45%, that's a lot of money.
Yeah, well, I mean, probably more. We all know Ed's going to live to 120, right?
Oh, yes, absolutely.
Yeah, for
sure. Yeah. And it will be Ed, I'm sure. So a spousal lifetime access trust may be something to consider. What else is available there? Well, there's something called a qualified personal residence trust, where you can take either a home or a vacation home. Neither one has ever been rented. It has to be legit residence, okay? And you can put it into a trust. But here's the deal. It's not a gift today, because anytime you put money into a trust, it's a form of a gift. So let's say that you have a property, let's say it's worth $1 million. And, we ran these numbers on a 60-year-old and we did a 20-year trust, and I'm just going to round off numbers. Because it's not a gift today, it's a gift 20 years from today, there's a certain discounting that is allowed. So instead of using up $1 million of that wonderful 11.7, we're only using $500,000. Okay? So the asset is in this trust. It's called a grantor trust. So if this is your situation, you continue to pay the real estate taxes and the utilities just like you owned it before. Okay? What happens at the end of the 20 years? Well, this is where you got to really understand how it works, okay? Because at the end of the term, everything's done, and, in this, the kids own the house. So if it's a house that you're living in, just understand that, you better be nice to those kids because they're going to own your house.
Yeah, right. But that's an interesting concept then.
Well, it's in the
Does that mean they have to come in and clean it then?
Oh,
if
yes.
You can live there, but they clean it?
Totally.
Yeah,
absolutely. That's, it's payback time.
And they got to put food in the cupboards.
You got
natural assumption.
Yes,
right?
yeah, exactly. And by the way, they got to provide the home health care. They got to do all that stuff.
Cut the grass.
Yeah.
Fill up Dad's lemonade when it gets low.
Yes. All right. So here's the real perk in the right situation, though. You know how you can leave $15,000 per person per year? That's the gift tax exclusion, right? So again, understand how gifts work. You can gift $15,000 to all of your children, their spouses, your grandchildren. There's no forms that have to be filed. There's no 709 gift tax return. You're good, okay? But what if you want to help one of the kids out with a home and you want to give them, $150,000 for, the down payment, right? Mm-hmm. Well, that's a different ballgame. That's a gift over the exclusion, so you have to file this 709. But here's the thing. You can use that 11.7 while you're living or when you die, right? So it can be used either time. So this is where we're taking advantage of it while we're living before it gets taken away. Right. So it's a neat way of taking advantage of the rules as they are. Now, a lot of people ask me, well, Patti, how about if I don't want to do $11 million, we don't have that much. Why don't we just do 3? Here's the deal. You're not really accomplishing anything, right? Because we know you're going to have 6 available under this proposal. So you're not really accomplishing anything. To really get some leverage out of it, you want a gift in one form or another: spousal lifetime access trust, qualified personal residence trust, or some of the other tools that we still have available through the end of December. It is a form of a gift, and you're using up that 11 million.
So I want to clarify that point, because that was it originally when I was looking at, that was a little bit of a point of confusion for me, which is if you don't maximize what's given to you, what's going to happen is it will go to 6, and then they will back out any prior gifts. So it's not like you can use a little bit above and you'll still have 6. It goes to 6, and then they back out the prior gifts. So to your point, if you don't utilize it, it's just going to go against, it's going to be a debit against that $6 million.
Exactly.
Right. So
right,
in essence,
because when you file that 709, they're keeping track. Okay. And they're keeping track of what your prior gifts are. And when someone passes away, that final tax return, it's adding up all those prior gifts to figure out, do you have anything left, or what is the excess and what's the tax?
Yeah, so I think, another interesting point that was left out, which was a big topic. Big. Right? Step up in basis, right? That's not there. So that there's still going to be, as it is now, a step up in basis.
So basically, and that's really important, Eric, and really important for everybody listening to know, because that was really contentious, and that was something that we were honestly really worried about. Here's the way this works. Let's say that you paid, $20,000 for an investment, and the value of that grows to $100,000 upon, as of the date of death, right? So you've held on to it, you didn't need the money, and now it's worth $100,000. Well, under current law and even under this proposal, the cost basis, what you paid for it, but it's an accounting thing, it just steps up to the fair market value as of the date of your death. So basically, I will tell you, in my own family situation, my parents had a place in the Poconos. They paid $50,000 for it. When Dad got sick, we changed the deed and moved it out of joint names, and we moved it into Dad's name. And we pretty much, had talked about it because Dad loved it, but Mom wasn't loving it. And basically what happened was when Dad passed away, that $50,000 cost stepped up to the value as of the date of death. That was $250,000. My mother sold the property. She paid no income tax on all of that gain. So step up in cost basis is important for your planning. It's important for your portfolio management, and it has been retained. So very important. The reason I'm kind of making a big deal about this is because, this would have been a very broad tax. Here, the administration is coming out and saying we're only taxing the rich, only those people making over $450,000 or $400,000, and only people who have more than $12 million in assets. We're not going to hurt, or we're not going to tax people, middle America. Guess what? That would have crushed middle America because it's a broader tax. I don't know about you, but there are a lot of people out there who have investments and real estate. Think about your home, okay? You've probably got a gain on a primary residence or a vacation home. Well, under current law, it steps up in cost basis. If they had said no more step up anymore, and it was worse. You ready for this one? They actually proposed that there would be a valuation upon death, and whether you sold it or not, you got to pay the taxes then. It was quite draconian.
Right. So you mean you have a tax bill without a cash flow to pay the bill, right? Because you haven't sold the asset.
Yeah. Which is really important, and you've brought up an important point with all of this. And again, this is not a whatever. But, when we think about America, right, we think about what is America made up of? It is made up of small businesses and farmers. The estate taxes really hurt small businesses, and here's why. Let's say that you have a business, and, I'm just going to use a value of, $5 million, okay? Now, here's the deal. You might think it's worth $2, but the IRS is going to think it's worth $5 because they want their money, right? So you've got this business and somebody passes away. The IRS says, okay, fork it over. You got to give us 45% of that business plus estate. So half of the value of that business, $2.5 million, has to be paid in the form of a tax, right? Mm-hmm. So family looks around and says, we don't have that kind of money. Where are we going to get that kind of money? And guess what? they got to sell the business. This is exactly where the term fire sale came about, because everybody knew, hey, this family farm has to be sold to pay the tax. We're going to give them 40 cents on the dollar, 50 cents on the dollar. And the family didn't have any choice because the tax bill was due in 9 months. And so they had to sell the farm or the business to pay the estate tax.
Yeah, and I guess the other thing that's a real challenge, assuming that, and again, this is all proposal, right?
Yeah.
But, these new grantor trust rules.
Right.
So, planning, would usually call for something called an irrevocable life insurance trust. To create a life insurance policy that's removed from the estate, but it gives you that liquidity. Because as you said, so much of America is made up of, small businesses and farmers. It's a liquid assets, and this was a technique to create the money to cover the tax so you avoid that fire sale. But now they're changing the rules on that, where that insurance,
right, is brought back into the taxable
can potentially
estate.
be brought back into the estate.
And again, I'm so glad you brought it up, Eric, because this is really important for everybody listening. If you have an insurance trust, an irrevocable insurance trust, which is exactly what Eric said. It was there, you pay a premium, you pay your $10,000 a year or whatever it might be for your $1 million insurance policy, and you hope you live a long time, but if you don't, at least that money would come in triple tax free, because life insurance, there's no income taxes due, there's no estate tax due, and there's no inheritance tax due, as long as it's owned by an insurance trust. Now, where do you come up with the money to pay the premiums? Well, typically, mom and or dad or both make a gift into the trust. It's held there for a period of 30 days. After that period, it pays for the insurance. That is what is being threatened, because if after January 1st, if you do that, the grantor rules are changing, and that's going to cause inclusion. Some of that $1 million that you thought was going to come in tax-free, well, guess what? It's not going to be tax-free anyway, or a portion of it. So the takeaway from here, the key consideration is, if this is your situation and you have an insurance trust and you really want to have it to provide that liquidity to pay the tax, and you can't say in the trust, please use this to pay the tax. It's a complicated formula. I'm not going to get into it, but the fact of the matter is, at least you have the money to pay the tax, so you don't have to have the fire sale, right? So the takeaway from this, or the planning technique, is front load your insurance trust between now and December 31st. Throw in 10 years of premiums. Again, assuming that you even have it. These are big world problems, big, problems. But again, if you don't know about it, you're not going to do it. And you're going to wish that you had. Throw in $100,000. And by the way, it doesn't have to be cash. You can transfer in existing investments. Just do a journal from one account into the insurance trust account. It's there to pay the premiums for the next 10 years. So you're good. So, again, we want to be creative. We want to be proactive. We want to understand the implications and how each one of you who is listening, the things that might apply to your situation, throw out the rest, right? But for those people where this might apply, there are things that can be done and honestly should be done. The thing about some of this stuff also is that there's no real downside. Right? You do a spousal lifetime access trust, right? So Ed set it up. Remember, he's setting it up for me. And he sets it up, but what if the law doesn't change? What have we given up? Not much. Okay. Yep. What about the personal residence trust? What have we given up? Really not much. Because again, it's a grantor trust.
Right. So proactive planning, right, really pays dividends.
You betcha.
And so forth.
Yeah.
All right. So what do you think?
IRAs, retirement plans. Fun
Sounds
stuff.
good.
Because that's going to affect a lot more people. So what's happening in the retirement area? I've talked long enough, Eric. You take it away here.
Thanks. So I think, there are some rules that really are not going to touch most Americans. So, there have been certain very crafty entrepreneurs that have used IRAs to basically accumulate massive balances in IRAs without ever paying any kind of tax. So these laws are really targeted at these certain individuals where an IRA balance might be above 10 or 20 million. Now, for the average person putting in the maximum every year, it's nearly impossible to get there without just an absolutely fantastic compounded rate of return, right? So these are situations that they're trying to head off. So, if your IRA is above 10 million or 20 million, now there are special required distribution rules regardless of age where you have to distribute that money. Again, most people aren't going to be, faced with this. I think the one that is, more germane to the average American, techniques that most people can take advantage of either individually or through employer plans, really deals with, rollovers and, conversions. They're really changing the rules there where, basically they want to eliminate the ability to move money from an IRA to a Roth if you're above certain income limits, to eliminate the ability to convert after-tax money into a Roth. You might have heard of this strategy called the backdoor Roth.
This is a big one. I think this is a big one personally because this is what we were having all of our clients do if they had it available through their employer and had the cash flow. And what that means is you could make contributions up to the Internal Revenue Service max, that $26,000 depending on your age, but you could still put in more into your 401k. You just wouldn't get a tax deduction for it, right? That's called an after-tax contribution. When a person retires under current law, you have a one-shot opportunity, and it's a great opportunity to take all that after-tax money that you were saving year after year after year and move that instead of rolling it over into a regular IRA, which you never want to do, FYI, you roll it into a Roth IRA. And guess what? You don't owe any taxes because you already paid the taxes on it. So it's a sweet deal. Most Americans are not going to be able to get that kind of money growing tax-free for the rest of their life when they don't even have to take required minimum distributions.
Yeah, so I think they're really just trying to, short circuit these ways to get money into Roth IRA accounts because, again, the growth will never, ever be taxed, and they're just trying to figure out, ways to kind of curb those avenues to get it in there. But the other thing, too, is, you have to distinguish some things like the backdoor Roth or kind of these in-plan conversions of after-tax money to Roth money, those things are being excluded. But some of these other things, conversions and rollovers, are dependent on income. So it's not like some of it is going away. You just, if you're going to retire, you might just have to defer a tax year before you do it. So that way you're in a lower bracket and so forth.
And by the way, and I'm glad you brought it up, this is not for everybody. There are situations where it does not make sense for someone to do a Roth conversion. It really doesn't. So again, run the numbers, understand the downside of doing it, because if you do a Roth conversion, you got to pay that tax right away.
Yeah, that's an important point. It's not like, the transaction is for free. You're just making an election. Is it better to pay tax now or later? And that's driven by tax rates and your assumptions. Okay, so
I hope it's okay, Eric. I just have to say this. So let's go back to the estate tax stuff for a second.
Oh, boy. All right.
Here we go. You think about people who have been saving. They have these wonderful balances in their IRAs and their 401ks. And let's say that someone accrues $2 million, right? Mm-hmm. Not unusual between a husband and wife to see that kind of money in a retirement plan. Basically, pass away, etc. The problem is that $2 million is included in their taxable estate, right? Mm-hmm. So, you stack on top of everything. So when you think about it, someone is paying a tax on a tax because the kids are going to have 10 years to pay the taxes on those. I say the kids, anybody, your heirs, are going to have to pay the taxes on that $2 million. So basically, $600,000, give or take, is really a tax that somebody's going to have to pay either right away or eventually. So when we include that $2 million, it's not really $2 million because $600,000 is going to go in the form of income taxes. But now you're paying estate tax on an income tax. So you're paying a tax on a tax. Okay, we don't want to do that. So for those people who may have an estate situation, this is the year. This may be the year to do a Roth conversion on those retirement plans. Pay the taxes while you're alive so that the kids aren't paying an estate tax on it when you pass. Does that make sense?
Yeah. Yeah.
Okay.
Gotcha.
All right. Good deal. Thank you for letting me.
No problem.
Digress.
Anytime you want to go back to estate taxes, you just let me know.
Oh.
I'm in the passenger seat here. You're driving. Maybe I'll chime in and be a front seat driver here.
All right, good deal. I say we pull this all together because I think that we've talked a lot about history. We talked about the history of taxes and what is being proposed and some of the key considerations. Really, from to kind of boil it down and really keep it as simple as possible. Here's the deal. If you have income of $400,000 to $450,000, above those amounts, those are the people who may be paying a higher ordinary income tax rate and higher capital gains. So just understand that going forward. When it comes to estates, there's a lot of things that may change. This is the time to consult your advisor, your estate planning attorney, to figure out, is there anything that we should be thinking about or considering? Okay? A lot of this other stuff, it's noise, and it will continue to be noise until we know what the final proposal looks like.
Yep.
The things that were not included, important. Step up in cost basis is still there. The SALT limitation, we were hoping that they would remove that, state and local income taxes, that $10,000 on your, your itemized deductions. A lot of states are pushing to remove that. That is still there. So that did not change. Like-kind property exchanges. Those of you who have rental properties, there is a nice little perk that you can sell one and buy another. And as long as it's a similar type of property and you follow all the little nitty-gritty rules, no capital gain tax due. That remained. That was also being threatened, but that did remain in this proposal. And then the for those people who have businesses, some of the discounting tools like family limited partnerships and things of that nature, that was being discussed, et cetera. Those opportunities will also remain.
Right.
Okay.
Discounting. So I think the other thing to remember too is that these are all proposals.
Yes.
So, and this is not the first one. So, our branch of government, the legislative branch, made up of the Senate and the House. The Senate has what's called the Senate Finance Committee. They are responsible for overseeing taxation. They have a proposal. The most recent one we're talking about today came from the House Ways and Means Committee, which is the House version that oversees tax policy. So, if they decide to come out with something new before the end of the year, looks like we have a wonderful opportunity to do another podcast because this is not the first time we've had one of these, and it continues to evolve. Yeah, with every iteration here.
All this stuff is very important. Again, keep in touch with your advisors. Those people have their finger on the pulse of what's going on in Washington and, most importantly, what you can be doing about it. So thank you, Eric. As always, this was fun. I hope you enjoyed it as well. Lots of topics and lots of information, history, etc., perspective, hopefully, and some action items as well. Things, key considerations that can make a big difference for you as well as your families. So thank you so much for joining us. Go to our website, keyfinancialinc.com. We'll have all of this information on the website. And in the meantime, I hope you have a wonderful fall. I hope you have a wonderful fall. Enjoy your family. Happy Thanksgiving. I'm hoping that this gets launched well before Thanksgiving. And thank you so much for tuning in. Take care.